Hi folks, welcome to this midterm review. This is question 1 and it focuses on the differences between the investment being accounted for using the equity method, which is the case when we have a significant influence investment, and it compares it to if the parent had used the cost method to record the investment, what the entries and statements might look like. You'll notice in this question that P, the investor, paid $500,000 for a 40% interest in S Company or S Limited, and that gives them significant influence. You'll also notice that if we look at the investee, S's year 6 statements, subsequent to the date they became related to P, you'll notice that we have profit before discontinued operations, but we've also added a couple of items from your prerequisite course relating to discontinued operations and some OCI in order to give us comprehensive income. So now we've given you some information on P Company, the investor's profits, which consisted of sales and operating expenses and some tax expense, and any investment income that it earns from its investee S. We've given you a tax rate. So again, using the equity method and cost method, you're going to do some entries, prepare a balance sheet for us, and an income statement. Okay, so let's begin our process. So now, in this question, we were asked to use the equity method. Under the equity method, we would debit the investment for what P paid for its 40% interest and credit cash for the same amount. We know that's $500,000 that was given to us in the question. Now, here's where the equity method of reporting and recording the investment will differ from the cost method. When a dividend is declared by the investee to the investor, what's going to happen? The investor, P, is going to record cash because if it got cash, and in our question we said they did get cash, the total amount of the dividend that the investee or the associate company, you can refer to them as either, the total dividend they declared and paid was $100,000, but because P only owns 40%, their share of that dividend was $40,000. Now, instead of crediting dividend income like you guys are used to from prerequisite courses, in this case, because it's a significant influence investment, we're going to credit the investment in S. That's in our subsidiary, in our related company, the associate, for that $40,000. All right. Now, if you'll recall, we also had a discontinued operation that the investee or associate had, and they also had some OCI. You'll remember that in our question, let's just pop back, that the discontinued operations loss that S booked in year 6 was $30,000. That's net of tax. Well, don't forget, some of that has to go on, and under the equity method, P has to take its share of that, just as it has to take its share of OCI. So now, if we go back to the solution, we have an entry here that's going to debit the equity method income based on our relationship with the associate because of its discontinued operations loss for $12,000. Don't forget the entire amount of DO loss was $30,000. P is just picking up its share. Because there was an unrealized gain on S's books, P is going to pick up its share, which is 40% of that OCI unrealized gain, which gives it $8,000 in total. Now we know that before, or any of that profit before the DO and before the OCI, that was $385,000. We were given that in the question, if you'll remember. It's right here. So P takes in its share of that as well. So now they take in their share of that, which is $154,000. So we've taken 40% times the profit before discontinued operations and OCI to get $154,000. So the investment in S account is going to be adjusted for what? P's share of the discontinued operation their share of the unrealized gain in OCI, and their share of any pre-DO and pre-OCI profit, right? Which is 154. So if you net it all out, it comes to 150,000. If you wanted to, you could plug that figure, or you could calculate it, because you know that the comprehensive income is 375, right? You had that right here, right? 375. So all that journal entry does is it breaks up amongst all of these 4 items. It breaks up how we calculate the investment account, or make one, what I would call one big compound entry. All right? Or, yeah, one big compound entry. Now, if you guys wanted to, and you didn't want to do it as a compound entry, because sometimes that can confuse students too, you can break it up into separate entries. So you can say, well, I'm going to take, I'm going to book for P their share of the subs inc, or the associate, the investee S, their income before the OCI and before the deal. So that is 385. 40 times 40%. So you're going to debit the investment and credit equity method income. You can do it that way. Then you can do a separate entity to take your share of the DO loss, which we already know is 12,000, and credit the investment account. Because don't remember, if you're taking your share of the loss, your investment is being credited or on the balance sheet, or it's being reduced, right? And don't forget, if you're taking your share in of an OCI unrealized gain, you debit the investment and credit your equity method income for OCI related to the associate for 8,000. Now, just to make sure you're clear, let's say this was an unrealized loss you had here. The OCI had an unrealized loss. Then you'd reverse this. You debit the equity method income for the OCI associate loss, and you'd credit the investment in S, right? So you got to really know if it's a gain or a loss. If it's a gain, you're going to increase. Or if it's a positive, like if it's a DO gain, or if it's an unrealized gain or OCI on OCI, then you're increasing the investment in S. But if it's a loss, like a DO loss or an unrealized loss in OCI, then you're going to credit the investment. But you're always affecting this account, right? So now, you can do it as 3, or you can do it as one biggie sized entry, as I call it. Up to you. All right. Now, I also asked you under the equity method to calculate the value of the investment in S account that would show up on P's separate entity equity-based statements. So here we have the investment at cost, which was the original cost of 500,000. You reduced it by 40,000, right? And you also, if you look here, you increased it by 150,000 to get 610,000. So the reduction of 40,000 was due to the fact that you credited the investment in S when they paid you out a dividend, and you also took in your share of the after-tax profit, right, which was 375. And again, we have that right over here. Let's go in here. Right there. That's 40% of that guy, and that's your 150. That's right here. Okay? Now, if we have to do the statement of comprehensive income, and I'm calling it the statement of comprehensive income because there is some OCI in here, right? We're going to record our equity method income, which is based on the profit before the DO and before the OCI of 154,000, and add it to sales to come up with our revenues here of 1,354,000. Now, some of you may be asking, why do I have to separate out that 154 from my share of the DO and my share of the OCI unrealized gain? Well, you know what? Remember, when you're doing statements in good form, remember the discontinued operation is always shown after your profit from your continuing operations after tax, right? You remember that from your prerequisite course? And we also know that the OCI goes after that. We did these things when we did your coursework in second and third semester. So hopefully you remember that or recall that as we're here in our more advanced course. So that's why we only took any profit before taxes and before DO and before OCI. And again, you'll remember from our question, that was 385. So 385 times 40%, that's going to give us our 154. Now don't forget here you had operating expenses. They were given to you in the question. We told you that P had operating expenses of $500,000. And you'll also see here that we've got the income taxes after we calculate our income before tax and before the discontinued operation of 210. So now we have net income before discontinued operations of $644,000, and then we took our share. We showed you up here when we did the entries. We took our share of S's DO, which was $12,000, and that debited or reduced our income. So we've got that loss in there of $12,000 that we took our share of. So now we've got net income of $632,000. And then we're going to add our OCI piece at the end here, which is our share of the unrealized gain of $8,000. And that's going to give us total comprehensive income of $640,000. Now, if we were using the cost method, life is so much easier for us here. Why? Because under the cost method, you don't have to take your share of anything. You don't take your share of S's income, and that includes not taking your share of the DO that S might have had or any OCI that S might have had. So it's a very, very simple process. You just debit the investment at cost to record what you paid for your 40% interest, and you're going to credit dividend income and debit cash for any dividend that you got. If that dividend had been declared and not paid out, then here you'd be debiting dividend receivable, right? Okay. Now the investment in S account balance is what you said it should be based on the fact that we're using the cost model. It stays at cost, right? So now you can see our statement of operations, because we have no OCI on it, no discontinued operation, either our own or from the company we're associated with, S. We just book dividend income underneath sales to get total revenues, deduct our expenses and our income tax, and we get profit after tax of $530,000. Notice I haven't called it comprehensive income in this case because there is no OCI, right? So now let's go on to problem 2, and we will do that in the next video. I hope you found this video helpful.